Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glen Sutherland. This week, my regular guest is Tim Miron. Tim, you want to start off by reintroducing yourself to everybody?
Absolutely, Glenn. Always a pleasure to be here. My name's Tim. I'm an accountant, the only grown-up job I've ever had. I run a firm called Pursuit CPA with offices in Burlington and Fonthill, and we work exclusively with entrepreneurs, those being either Canadians that own businesses in Canada or entrepreneurs who are Canadians who are investing in U.S. real estate.
Yeah, and what I wanted to do is have Tim on a regular basis just to cover some of the common questions I get and just to honestly help people as much as we possibly can. So anyway, the question we really wanted to tackle this week is how do you reduce your taxes on these rental properties? I'm sure there's some tricks or some planning that can be done from an accounting perspective.
For sure. The tactic that we're going to talk about today relates to using the right structures or entities to convert what would otherwise be considered passive income for tax purposes into active income for tax purposes. Because regardless of which side of the border we're paying tax on, passive income has a higher rate of tax than active income. The rates are all over the map depending on what state you're in the US. We won't talk to those, but for comparative purposes in Canada, if you were receiving rental income in a corporation, the tax rate can be as high as 50%, whereas active income can have a tax rate of 12% in Ontario. So that's a pretty big swing. Do I get to keep half of my rental profits or do I get to keep 88% of my rental profits? And so that's what we're talking about today. And the way that we do this with a lot of clients, and there are some restrictions that we'll come to, is we have a structure where one of the entities, eventually it ends up being a Canadian corporation, if you're a Canadian resident, of course, acts as like a property manager for your portfolio. That does get trickier if you actually do have a property manager, but that's it. And so property management income is considered active income. So we need to actually be doing some of the activities that would look like you were managing the property. And so what you can do is then you could take a percentage of the gross rent, just like a third-party property manager would do, from the U.S. entity that holds and is collecting the rent, and have that be income in your property management company. And so it would be taxable in Canada and subject to 12% tax.
So this all comes down to the way you've structured this company right off the start. So from my understanding, you're going to need a Canadian corporation on the top in order to take advantage of this. Are you looking to invest in the U.S.? Are you looking for a coaching program that will actually save you money and help you avoid mistakes? My students get discounts on lawyers, attorneys. If you're looking to get an E2 visa, if you're looking for certain software, if you're looking to even speak with CPAs, I have discounts for all these things. If you want to just get on a quick phone call and we can discuss if it's a fit for you, 10-minute phone call, go to glensutherland.com or at CanadianInvestingInTheUSA.com and book a call.
Yes, it is frequently on the top. It doesn't have to be on the top. And so if you've already started your investing portfolio and you don't have a Canadian corporation yet, that can be added in after the fact. Yeah. Okay. But it doesn't technically have to even own the U.S. entities if that's the case, because it's just going to be invoicing your U.S. entities for the property management services. So it doesn't even have to have a direct ownership. Often it does for other reasons, but that doesn't impact the ability to recharacterize some of that income as active income versus passive and have the lower tax rate.
So does this... because I'm just thinking of this, there should be a similar amount every single month. Should it be like a regular occurring type of thing?
Absolutely, yeah. And that's part of how we legitimize that and make it a solid filing position is we are going to invoice for a percentage of the rent collected, and it would be a consistent amount percentage over time. And it does have to be, we can't go and, if it's a super profitable property with not a lot of carrying costs, we can't go and invoice for 30 or 40% of gross rents on a stabilized property, because that's just not the going rate, right? We have to go back and say, okay, what would an external property management company charge, and we need to be in that ballpark.
So if you were trying to, like ultimately we're trying to get our money from the US to the Canadian corporation and then before we pay ourselves. So what if that, small amount isn't enough? Like to be bringing back, like you say you were, well, make up some flat numbers just to, I think
Yeah,
examples work better. So if you
yeah.
wanted to bring back, I don't know, 5,000 or let's say 5,000 every single month to your account, but based on, 12% of the gross rents, it's not high enough, but there is more income there. Is there something you do in that situation?
So the rest of that is going to come back as property income,
Okay.
and is probably unavoidable at that spot. Um, and yeah, so depending on what your structure looks like, that could just be coming in as rental income, depending on who the owner is. So it may not go to the corporation, right? If you are the direct owner of an LP structure, is often the answer. That could just come to you as rental income, and that might actually be better than having rental income go to a corporation, depending on what your personal income levels are at, because corporation only has one rate of tax on property income at that 50% ish.
Yep.
But rental income received by an individual is just added to their marginal tax rate. So if your income is, $50,000, $60,000, including what you've just described in your example, you might be paying tax at only 30%. So wouldn't make sense to have the rest of that flow through a corporation.
Okay.
If you do have a corporation, though, that 50% is actually two parts of tax. One is pure tax, that just goes away. The other is this complicated thing called refundable tax, that is meant to make it so you're indifferent whether or not you're earning income personally or in a corporation. So what happens is, if the company earns passive income, that 50% tax, but then pays Glen a dividend, for every $100 in dividends that we pay Glen, the company's getting $38 reduced on its corporate taxes. So that 50 can become 19% tax potentially, because we're now flowing the money out to Glen and somebody's paying the tax.
Okay. So when you're calculating all this, I'm just thinking more of your side of the whole thing. You have to do
Yeah.
the corporate tax returns first and then the personals?
Yes, but when we would initiate this and set it up, right? Because it would be hard to, you could maybe do it once, but going forward, it would be, hey, we want this money to flow this way. So we'd be talking about, hey, let's look at what we can do for the rest of 2026 and make the money flow and optimize. How do we get $5,000 a month back out of the company? Well, I can flow 1,200 into the Canadian corporation as a property management fee, and now the rest of it has to come this way, and this is how it would flow.
Okay. And like for some people, that might be not an easy calculation to sort out, like the 12%. It's even like when people are trying to calculate how much CapEx to keep in accounts. Depending if it's a percentage, can be complicated because rents vary if they paid rent, if they didn't pay rent, if they're behind. Like the amounts are going to have to change every month. It sounds like a bookkeeping nightmare to even pay yourself.
But at the same, you're probably not wrong. But if we have some set calculations, and if the numbers get big enough that this makes sense,
Yeah.
Ideally you're getting some professional help on the bookkeeping side as well, to take care of that stuff. Yeah. And so you could keep doing it the simple way.
Yeah.
It just means you're going to pay way more tax than you have to.
Interesting. It's okay. For someone who's managing this themselves, you mentioned it sounds like you should be invoicing the US company from the Canadian company. Is there anything else they should be doing?
Actually making the money move would be one
Okay.
of them.
Yeah. Yeah.
Yeah, it doesn't have to be exactly every month, but it should look consistent and regular.
So like every quarter or every half
Yeah.
year, or I don't know, just something that's I think the trick is that make sure it just doesn't look like you're trying to fool the tax man and making a large sum transaction in December or something, just to math it
And
out.
then the other part of that, is making sure that we can show exactly how we picked that number, right? Having some support for that. And this is not likely to be asked for, but you also want to be prepared for it of, are you able to prove what you're actually doing looks like property management work? So that doesn't need to go into the tax return itself, but, we would just want to make sure that you can show that that was being done from the Canadian side of the border.
Makes sense. Okay, and you said that they can add this corporation later at the top, and it doesn't actually have to be tied specifically to be the ownership because you're just invoicing. So, if you think about it, like a property manager, they aren't part of your company, and they would basically, they invoice and just subtract off your rent before they send it. So it'd be similar to that.
Yeah.
Okay. And is there any circumstances where you could be taking a flat amount rather than a percentage of the rent?
I think as long as it's in that right ballpark, I think that makes perfect sense, right? Again, going back to your example, you probably couldn't do on, $10,000 a month in gross rent. You probably can't do a flat $5,000. But could it just be, hey, this is in that ballpark of what a property management company would charge, and we're just making it flat to make it easy and transfer? Absolutely. I don't see an issue with that. The other thing we didn't talk about is you'd use the example of, I think, 10 to 12%, which is kind of the going rate for a stabilized property. If you're into the business of, rehabbing a property and doing a whole bunch of renovations, now that percentage can probably be 2 to 2.5 times that number, right? It could be somewhere in the 20 to 30% range, just because that's a more active thing. So,
And if you
knew we were going to be profitable quickly, right? Because the other reason is you probably don't need to do this if in the first year or two we're actually going to not have a rental profit. Well, there's the tax rate on a loss is 0. There's no way I can make that tax any lower.
So in the purpose of this is to convert passive income into active income, because active income is taxed cheaper in a Canadian corporation.
Correct.
So if you already had active income in the US from, an actual property management business or a flipping business or anything like that, you wouldn't need to do this same, 10, 12%. You could just bring that amount directly back, correct?
Yeah. There's a few different ways that could happen. Yeah.
Okay. And what do you mean by that?
So one is if you have an active company in the US already, you could just take that money back as a dividend, let it get taxed in the States. And again, each state has slightly different tax rates. Or you could do the same thing where you have a US property management company and your Canadian corporation charges your active business for the fact that you're running it from Canada. Which one of those comes down to where the money's going to end up, right? The tax rate on active income is still lower in Canada than it is just about everywhere in the US. So that's a great plan, unless you're then just going to suck all that money out of the company. So that makes sense if you're earning enough money that you don't need it personally to have that US active business have a management fee charged to it from the Canadian company.
All right. If people are listening to this and they're confused, this is where you talk to to Tim. I still got that stuck in my head, but this is where you talk to Tim. or Tim's massive team over there at Pursuit. Is there anything I should have asked you about this or that you wanted to cover? Maybe before I...
No, I think we got through everything that I would have wanted to mention.
So Tim, if people are like, "Hey, I want to make sure I got this set up. I want to get some help with my bookkeeping, or I want help with planning for my taxes or doing my taxes," where do they reach out to? Where do they find you?
Yeah, if it's on this, our website is www.pursuitcpa.ca. You can find contact forms there, or if it's specific to cross-border stuff, we've got some people teamed up on that. The email is crossborder@pursuitcpa.ca.
Perfect. Thank you so much for coming on the show again. Like always, tons of value. Thank you so much, Tim.
My pleasure.
That was a nice video. Bye.